All right, let's check out your Chapter 2 homework. And I'm looking at problem number 1. And they just want you to prepare journal entries. And so I'm just going to walk with you each of these. Notice the first one, part A, says you borrowed money from the bank. You're going to be debiting cash, increasing cash, and because it's a debt, you're going to be crediting notes payable for that $39.40. On part B, it says you received cash from investors from issuing stock. This is just one of those investments, so we're going to be debiting cash. And then common stock will be our investment account that we use when we sell stock. Part C says we bought some equipment. We paid $200 cash. The rest is on a note. So we got debit to equipment of $1,000, credit cash $200, and then the balance of $800 would go to note payable short term. D, paid $300 cash for supplies. You've seen this one several times. You just simply debit supplies, credit cash. Remember, that's just a shift in assets. And then the last one, bought and received $700 of supplies on account. That would be debiting supplies. Notice this one goes to accounts payable. That would be the credit. All right, so that's problem 1. Let's check out problem number 2. And this one, they want you to categorize the different accounts and then say if it's got a normal balance. And so I'll walk you through these. So the first one, accrued liabilities. Usually accrued liabilities would be a current liability. Most of the time you're accruing them to be paid the next month. And of course, because it's a liability, it's got a credit balance. Prepaid rent usually is a current asset, and because it's an asset, it has a debit balance. You know, usually the prepaids are mostly like prepaid rent or prepaid taxes or prepaid insurance. Usually those are going to be used within a year, so that's why those are current. Cash is always a current asset, debit balance. Common stock is equity, stockholders' equity, credit balance, note payable against the liability. Long term, so it's non-current, again, credit balance. Equipment is a long-term asset or non-current asset, again, it's a debit balance because it's an asset. Retained earnings, again, is part of stockholders' equity with a credit balance. And then finally, accounts payable is always going to be a current liability, which again has a credit balance. All right, let's check out number 3. And this one, they just want you to analyze how these items would affect your accounting equation. So again, you bought some equipment, paid $5 in long-term note, the rest is with cash. So notice equipment would be increasing by, it looks like it's $216. And it says they had a $5 long-term note. So you've got, here's your note payable, and of course $211 would be taken out of cash. So you got $216 minus $211. Of course, that's going to make sure your accounting equation is still balanced. You got issuing stock for cash contributions. So again, we're going to be getting cash increase and then increased common stock. And then the last one, this is just where investors are trading with each other. This doesn't affect the company's internal financial records. So in part C, there would be no entry on that one. And then down here, they ask you a couple questions as well. I just kind of gave you that one away. All right. So that is number 3. And it looks like somehow this one kind of got duplicated, but they want you to do the same one in this case, and they just want you to do the journal entry. So it's the same transactions, but you can see here's how the debits and the credits would look like for both A and B. Buying equipment, paying some cash, the rest is on a note. So again, you're debiting equipment, crediting cash, crediting notes payable. And then on that cash sale of an investment, you're debiting cash, credit common stock, and of course, no entry on part C. All right, so on this one, they want you to do a few things. Notice we've got some beginning balances. It looks like we've got some transactions during the month of July. So they want us to go through, we'll take a look real quick at the accounting equation. Then we'll look at the journal entries, and then they want us to look at the ledger. And then of course, trial balance, and then they want us to look at the balance sheet. They don't want you to do an income statement or retained earnings statement, because when we go through these transactions, you'll notice there are no revenue, again, or expense transactions. These are all, again, balance sheet related. All right, so let me get my mouse. Okay, so here we go. So part A, issued shares of stock for cash. So notice we're going to be debiting the cash, or I'm sorry, increasing cash and then increasing common stock. B says you borrowed cash from the bank. So again, we're going to be increasing cash and increasing your notes payable. Part C, bought a building, 182, you paid cash, the rest is the note. So you're going to increase that building by 182. decrease the cash by 82, and then the balance of 100 would go to note payable. D, you paid cash for equipment. So notice that you got equipment increasing and cash decreasing. That's just a shift in assets. And E, you got purchase supplies for 30 on account. So you're going to be increasing supplies and increasing accounts payable. So then we go down below and you can see here the appropriate journal entry. Now you're just basically plugging in your debits and credits. You can see debit, cash, credit, common stock. Same thing, but debit, cash, credit, notes payable. Here you got the buildings, you bought the equipment, and then you bought the supplies on account. So once you do all these, then of course you would post these. You could do a trial balance, but you could also post these eventually to your T accounts, which is your ledger, and then eventually get to your financial statement. So here's your ledger summary. Notice you have 1, 2, 3, 4 transactions that affected cash, 1 transaction that affected supplies. You can see that. Notice they have the beginning balances on there, and then know where the ending balances are. Once you get that, you can look at your trial balance to make sure that your debits do equal credits. So this again is just pulling right from your ledger, just to show you this. Again, all the stuff is automated, so you know you're always balanced, but just to kind of show you the concept, you can see that your debits do equal your credits. And then the last step is simply to plug this into your balance sheet. Don't forget the date. The balance sheet has one specific date. Notice we've got 2 current assets, cash and supplies, and then equipment, building are the non-current or the long-term, and land are the long-term assets. Total assets $1,091,000. We have 1 current liability and 1 long-term liability. And of course you get your common stock and retained earnings, and you can see how you are balanced again from your accounting equation. All right, and I think you just had one more question to answer on number 10. But at that point, of course, it's primarily looks like their financing is from stockholders' equity. And the reason you know that is if you go back to the balance sheet, if you look at common stock, that's the equity, and that's 580 versus your liabilities, which are only at looks like 50,000. So it looks like primarily it's being financed mostly by equity right now. So that's where they would come up with. They're doing the total, but usually if you break it down individually, you can see right away common stock is a lot more than your long-term or your short-term liabilities. All right, and I believe that's it for my comments on the chapter 2.